Hey, what's going on, guys? It's Yar here. I'm super excited to share with you guys my portfolio update. This is the one I started on M1 Finance just a couple of weeks ago. I started with an initial deposit of $300 and been doing an additional deposit of $500 every single 2 weeks. I did a review on M1 Finance, the investment brokerage, the link right here to the video. If you guys are interested, check it out. I'll go over the pros and cons to it and the holdings in my portfolio. And if you are interested in this portfolio, I'm also going to be sharing with you guys the link down below. You could go in and add the portfolio to your investment account and just follow along if you like. But I'm super excited to share with you guys. The results have been amazing, and make sure before I get into this, you smash that like button, hit the subscribe and notification bell, and I'll be posting more portfolio updates every single week, and you guys can follow along exactly what I'm doing. So here's my M1 Finance portfolio. As you can see, I started this on April 27, 2020 with $300. And the reason I started was just to test out the brokerage to see how I like it. I created a review of this. If you are interested in that review and pros and cons of this brokerage, you could check it out in the description below. I'll drop a link and it's also right here. So today I want to go over the top 3 positions in my dividend portfolio. The goal of this portfolio is for long-term dividend growth. It's going to be a source of passive income for me in the future, and I'm just starting this out and I just want to track my progress. Every 2 weeks I have been depositing $500 cash and just investing into this pie chart I created. I'm not a financial advisor, guys, so if you do want to follow along and if you do want to invest in this, you do so at your own risk. I have been doing really well with this portfolio so far, and actually I'm going to continue investing in this portfolio. So the top 3 positions I think right now in my portfolio, which I really like, are ABV, AT&T, and Prudential. So ABV right now I'm up only 11.46% on it. It's about 6% of my portfolio. AT&T I'm up almost 15% on it. It's also 6% of my portfolio. And Prudential is 4% of my portfolio, and I'm up almost 31% on it. So I'm gonna go over each one of them and cover what I really like about each one of them. And also, if you stick to the end of this video, I will be sharing with you 3 positions in my portfolio that I think are really undervalued right now, and I am just going to be buying a shit ton more of this going into the future in my other accounts. So first off is ABV. What I really like about this company, it's got strong revenue growth consistently for at least the past 5 years. We could look back further, and it's got a consistent revenue growth for much longer, but using Seeking Alpha, you can see that the revenue growth has been increasing every single year. It's a sign of good management, sign the company is growing and it's going to be around. And if you look into the dividends, it's paying a 5.03% dividend yield. It's pretty high. That's just on its own, the dividend yield is a pretty good return on your investment, but it's also been climbing. I'm up 13% on ABV in my portfolio, so right there is 18% annually, and I think the ABV is going to continue to climb higher. It's got a extremely high dividend growth rate. Its 5-year average growth rate is about 21% per year, and it's been consistently growing for the past 7 years, showing that the management's pretty committed to increasing the dividends and paying out the dividends. It's got a 45% payout ratio, meaning that it's got a pretty safe dividend. It's not going to go anywhere. They are paying out 45%. I think up to 60% is okay. I wouldn't really want to see a company paying more than 60% unless it's a certain type of industry like real estate or mortgages. I usually try to stick to companies that's got dividend yields under dividend payouts under 60%. So the next one I really like is AT&T. AT&T's dividend is 6.35%. That's really good. Its payout ratio is a little bit higher, just like I mentioned before. It's above 60%. Okay, but it's been paying dividends out for a long time, and its past 35 years it's been consistently increasing the dividend. So it's showing that the management is very committed to increasing that dividend, and it's been doing it for 35 years. And if you look at the key data here, if you look at the revenue, it's consistently been increasing for the past 5 years, you know, from $146 billion of revenue to 181 in December. It's consistently growing, which I really like. I don't think AT&T is going to be going anywhere in the future. I think AT&T, you know, is going to be around for a long time, and they're doing a lot more innovation recently with 5G, with HBO, and other investments they're doing. I think they're going to be around for a long time, and it's a really good company to hold in your portfolio. And the third one I'm going to cover today is Prudential. It's a financial sector. It's been hit really hard by, you know, the pandemic, so that's why I have such a high return on this so far, and I think it's going to continue going up. It's a really good value. Its revenues have been increasing consistently for the last 5 years, which is really what I like to see. If you look at the dividends, it's a 6.36% dividend payout, really high. It's been increasing the dividend for the past 11 years with an average growth rate of the dividend of 13.01% in the last 5 years. Its payout ratio is 49%, which is showing that the company can continue to increase their dividends, and it's got a high safety for their dividend. If you look here, this is what I really like to see, a consistent increase in the dividends, and it's been doing that since 2013. I just want to show this chart to you guys with also ABV and AT&T. I like this visual representation. If you look at ABV, it's just been consistently increasing it. In 2013, the quarterly dividend was only 40 cents each quarter, and now it's $1.18. So really strong growth rate, and it's going to continue climbing. And if you could see AT&T, AT&T has just been killing it for a long time, since 1995. Look at this, it was paying out just under 20 cents per quarter, and now it's paying out 52 cents every quarter. So this is a really good position long term. Now I want to cover the 3 most undervalued stocks in my portfolio that I think have a lot of room to grow. If you look at the returns, and you look at the first one I want to cover is Pepsi. Only up 3.5% on this. It's only 3% of my portfolio, but I have been investing more into Pepsi in my other accounts. So if you look at Pepsi, look at that key data, you could see that Pepsi has consistent, strong revenue growth pretty much every single year. Pepsi has been very innovative. I think they're doing better than Coca-Cola, and I think it's a better play than Coca-Cola in the long term. I think Coca-Cola is a mature company, but they're also competing with a lot of other competitors now, so they're not doing as well as Pepsi. I think Pepsi is a better investment. If you look at the dividend scorecard, they pay a 3.09% dividend yield with 48 consecutive years of dividend growth, and in the past 5 years the average growth rate of the dividends 8.41%, which is really high. The one thing I don't really like about Pepsi is that its dividend payout ratio is pretty high with 76.81%. But I think this is a undervalued company, and that's why I decided to invest in it, especially during everything that's going on. You could get it for cheap, and it's going to be continuously increasing the dividend, and I think the company is very strong overall. Look at this, guys. In 1989, it was paying about 4 cents a quarter per dividend, and if you look in the last dividend was $1.02. So if you're looking for a long-term hold, I think Pepsi is a great choice. The next one I want to look at is Cisco. It's about 3% of my portfolio. I'm up only 8.29% on it. It was actually a later addition to my portfolio. I did want to diversify my portfolio into different industries, including financials, real estate, technology, consumer goods. And so I had decided to add Cisco. Cisco stock ticker is CSCO. If you look at the dividend history, it's just consistently been increasing. It was paying out 6 cents in 2011 per quarter, and now it's 36 cents. If you look at the dividend scorecard, Cisco has a strong dividend growth, about annually 13.27% growth on that dividend for the past 5 years on average, and it's been increasing their dividend for the past 8 years, and the dividend yield currently is 3.01%. Keep in mind, guys, that even though these dividend yields are pretty high, I did get them at a much cheaper price. So the dividend yields, even though they're really good right now, when everything dropped, you could have got them for much cheaper, paying out a much higher yield. If you look at the key data, the company has consistent revenue that's trending higher. So you can look, it's not strong revenue growths in the past 5 years, but it's consistently uptrending, and in 2019 had a much bigger increase, and I think that they're going to be around for a long time, and that their dividend is safe with only a 45% payout ratio, and it shows that the management is also got room to increase that dividend. The last one I want to cover that's pretty undervalued right now is Home Depot. It's 3% of my portfolio. Again, I'm going to be adding more to this in my other accounts. I'm only up 9.56%, and it's only been a few weeks, and I'm up about 10% on it. It's pretty good. But Home Depot is very underrated company. If you look at Home Depot, they've been increasing their dividend for the past 11 years with the average dividend increase about 23.68%. That is insane. This company is very committed to increase their dividends. It's at 60%, which is that target that I mentioned earlier in this video. It's right there. They're keeping it pretty safe. It pays out $6 a year annually, and currently the yield is 2.35%. But if you're keeping it long term, that yield is going to increase significantly based on this growth rate. And if you look at the key data, Home Depot has been killing it consistently. Strong revenue growth. Look at this consistent revenue growth. It's amazing company to hold, and this is something I definitely want to be investing in more of. And if you look at the balance sheet, also this is something that I like to look at. Okay, looking at the current assets, they have about $27 billion of current assets. That means it's about current assets is when the company expects to receive or turn this into cash within the next year. They got about $27 billion worth of assets and about $23 billion of current liabilities. That means for the next year, they don't even need to make any money, and that they'll be safe company. But you can see that Home Depot's Revenue has been increasing every single year, so this is not going to be an issue. The company's strong. It's got strong management. Its dividend has been increasing extremely high, and this is something that you guys should really consider to add to your portfolio as well. So the last thing I just want to talk about right here is the gains. Okay, 22.61% returns in just a few weeks. That's a pretty insane return. Okay, I've noticed a lot of people have been switching over to value buys. So if you look at tech and healthcare, those were the companies that were the most safe when everything was dropping. And now that people are seeing that, you know, the market's rising, people have been switching to value buys. Okay, those buys that have been the sectors that have been hit the hardest. So real estate and financial sector has been hit hard. So those are the ones that have been showing me the greatest increase. And if you've made it this far to this video, thank you guys so much for watching. I appreciate it, and I hope you guys have a great weekend, and I'll see you guys in the next video.